Dividend investors, bonjour, this is Mike Yeru, founder of Dividend Stocks Rocks and passionate investor. Today I'm answering an important question does it really matter if a company shows a payout ratio over 100%? Most importantly, what's happening and what you should do as an investor if you find out that one of your stock in your portfolio shows that payout ratio over 100%. But first, let's go back to the basic for a second, and then let's understand what is the payout ratio. So basically, the payout ratio is designed to help you identify and assess the dividend safety, the dividend health of a company. So the way it's calculated is you take the dividend per share divided by the earnings per share. So basically, if you have a company declaring a $1 dividend payment and earnings per share of $2, you divided 1 by 2 gives you a 50% payout ratio, which is pretty good, right? In an ideal world, you would look for companies showing a payout ratio under 85, 80%. Some people will say, I don't even go over 60. Depends on the situation, depends on the industry as well. But overall, if you have a company that pays less than 80% of its profit, you should be on board with a good dividend grower, because you need also that dividend to be safe, but you also want to make sure that the company will have enough room to increase it in the future. So what happens when the dividend payout ratio goes over 100%? So imagine in the same situation, I still have a company paying a $1 dividend, but now the earnings goes from $2 to 70 cents. So this means that for every dollar paid in dividend, the company only makes 70 cents in profits. It has to found it will likely borrow the extra 30 cents to pay the dividend. Does that make sense? Not really. It's pretty much like if you would borrow money from the bank to pay your children for their allocation because they're cleaning the room. And let's be honest, they're not doing such a good job that you should borrow money, right? But before you panic and sell your stock because you think that the dividend will be cut, it is important to understand the payout ratio has lots of flaws. One of them is it's being calculated using accounting principles. The earnings and earnings per share is based on accounting principles. This means it's not really based on real cash flow, real cash in the bank. Let me explain that to you with an example. Imagine that you, as an individual, is a business. So in your business, you're making your salary, which is your revenue. So let's say that you make $100,000 every year. That's your revenue. So that's your salary. Therefore, in your income sheet, you'll report $100,000 in revenue. Now, imagine that the housing market is very bad this year, and you have to report fair market of your house that lost $30,000. So if you would have to sell your house today, you would sell it $30,000 less than last year. So therefore, on your income statement, you will show revenue of $100,000 minus fair value of your house of $30,000, which means that you're left with $70,000 in revenue. Unless you sell your house and then take a big loss and you cannot pay your home, but if you stay in it, you're still going to make $100,000 in revenue, and the house price fluctuation will not affect your cash flow. So you will still be able to pay your children's allocation to clean up the room, and you will not have $70,000 in your bank account, you will have $100,000. So this is where the difference makes a huge impact on the ability of any company to pay their dividend. Obviously, a dividend payout ratio over 100% is still something that you need to worry about. You need to investigate a little further, and you need to understand what is happening. So let me show you an example that I really like for this, which is Enbridge. So now we are on Dividend Stocks Rocks website, and then you have Enbridge right here. You can see that dividend yield is at 7%, which is pretty high. So let's go a little bit further and look at the dividend triangle. So you see that revenues are increasing, earnings are increasing, and obviously dividend is increasing as well. The thing is, the dividend is increasing a lot faster than revenue and earnings, which leads to, when you go through the dividend growth perspective, to a payout ratio of 111%. and a cash payout ratio at 180%, which is even worse. Remember in my previous example, I was telling you about the fact that the payout ratio doesn't look at the cash flow of the company and what's in the bank account. Well, the cash payout ratio will. Actually, the cash payout ratio is calculated using the free cash flow. But the thing with the free cash flow is you have to take away all capital expenditures. So basically, if a company has several projects, this counts into their CapEx, their capital expenditure budget. You have to take that away from your free cash flow statement. And this is how a company like Enbridge, which is capital intensive, that spends billions of dollars into several projects, has a bit of a problem using cash flow to pay its dividends. So it really looks like the company is going to the bank to reward their shareholders. In reality, what's happening here is Enbridge will finance their projects. So they will finance their CapEx with debt or by issuing new shares or whatever. And then they will use distributable cash flow to pay their investors. How can you know that? Well, if you're a DSR member, you'll get it right here, and then you have the explanation. But if you're an individual investor and then you see a payout ratio of 111% and then a cash payout ratio at 180%, and you don't understand why Enbridge keeps raising its dividend double-digit year after year, then you must go to the investor's website. So in the investor's website, you can just type Enbridge Investor Relation or Investing Website, and then you'll get there. You see Investment Center Dashboard. You'll have plenty of information over there, but what you really want to look like is quarterly earnings or annual statement that will tell you what's happening with the dividend. So I already pulled out the research here. Basically, this is the 2019 financial results of the business that was published in February 14, 2020. So we're quite accurate right here when you look at the data. And what is very interesting here is you're going to get more information about how the company is calculating its dividend payment, and they use distributable cash flow. So they will show you how they have adjusted their budget, their EBITDA, and then further modification to the statement, and then you'll have the distributable cash flow and then the DCF per share. So as you remember back in 2 seconds ago, dividend per share is at 81 cents, and last quarter they generated a distributable cash flow per share of $1.02. So what it tells you is instead of showing a payout ratio of 112 or a cash payout ratio of 180%, actual payout ratio is more likely around 80%. And if you look at the past 4 quarters, so for the full year, you had $4.57. Therefore, the distributable cash payout ratio is even lower than 80%. This means that Enbridge is making lots of money, generating lots of cash flow, and you don't have to worry about its dividend for at least another year. Now, looking at the payout ratio will only tell you what's happening right now. So it will tell you if there's enough money in the bank account and if the company is able to afford its next dividend payment. It won't tell you what's going to happen in 2021, 2022, and so on. So for that, you'll need a broader investment analysis process. You will need to look at revenue growth, the growth vectors, how they are positioned in the market, what's happening in the economy. Is it a recession? Are the stores are closing? Which kind of business it will become in the next 5 years? You look at earnings trends or cash flow trends to make sure that the company keeps increasing this, because you need to have revenue increase, earnings increase, or cash flow increase if you prefer to do a little bit dig further to get eventually a dividend growth. And this, my friend, is the secret about every dividend growers. You need to analyze the past, the present, but then you also have to think about what the dividend triangle will look like in the future. So I hope that you now understand that when you see a company with a payout ratio with over 100%, it doesn't mean that there's a cut. You need to dig further, you need to get information, and most importantly, get it directly from the website. You know, all companies will share with you a lot more information, detailed calculation, and they will explain you how they intend to keep paying their dividend. So now I'll let you back to your morning coffee, I'll get mine, And until the next video, stay invested.